One of the most confusing moments for investors happens when a company reports what appears to be strong earnings, only to see its stock price fall shortly after. Revenue beats expectations, profits rise, guidance looks solid, and yet the market reacts negatively. This often feels irrational, but it is actually a normal and repeatable feature of how markets work. To understand why stocks can fall after good earnings, we need to look beyond the numbers themselves and focus on expectations, positioning, and valuation. The most important idea to understand is that stock prices are not based on absolute performance. They are based on expectations. By the time earnings are released, the market has already formed a view of what good looks like. Investors have analyzed forecasts, rumors, management signals, and industry trends. The stock price going into earnings already reflects those expectations. If earnings meet expectations but fail to exceed them by enough, the result can still disappoint the market. This is why good earnings are sometimes not good enough. A company might grow revenue by 10%, but if investors were expecting 15%, the stock may fall. Earnings are judged relative to what the market had priced in, not relative to last year's results. Markets react to surprises, not achievements. Valuation plays a major role in this reaction. When a stock is already trading at a high valuation, it implies very optimistic expectations about future growth. In these cases, earnings need to be exceptional to justify the price. Even solid results can trigger selling if they do not reinforce the narrative that drove the valuation higher. In other words, the better the story already embedded in the stock price, the harder it is to impress the market. Another important factor is guidance. Investors do not just care about what a company earned in the past quarter. They care far more about what management says about the future. If guidance is cautious, uncertain, or merely confirms existing expectations, stocks can fall even after strong reported numbers. Markets are forward-looking. Yesterday's earnings matter less than tomorrow's outlook. Investor positioning also matters. Ahead of earnings, many investors buy an anticipation of positive results. When earnings are released, those investors may decide to take profits, regardless of how good the numbers are. This, by the rumor, sell the news behavior is extremely common. When enough investors try to lock in gains at the same time, selling pressure pushes the stock lower. Broader market conditions also influence earnings reactions. During periods of tightening liquidity, rising interest rates, or declining risk appetite, markets are less forgiving. Good earnings may be overshadowed by macroeconomic concerns, sector rotation, or shifts in sentiment. In these environments, stocks need more than strong fundamentals to rise. They need supportive conditions. Another reason stocks fall after good earnings is margin pressure. Revenue growth alone is not enough. Investors closely examine costs, margins, and efficiency. If revenues rise, but margins decline due to higher costs, markets may interpret this as a warning sign about future profitability. The quality of earnings often matters more than the headline numbers. Sometimes, earnings are good, but they mark a peak. If investors believe growth is slowing or nearing its limits, even strong current results may signal that the best is behind the company. Markets constantly try to anticipate turning points, not celebrate past success. Stocks often fall when growth transitions from accelerating to decelerating, even if growth remains positive. It is also important to remember that markets are not designed to reward fairness or logic in the short term. They reflect millions of independent decisions, emotions, risk constraints, and time horizons. Short-term price movements after earnings often say more about market psychology than business quality. This does not mean fundamentals do not matter. It means timing matters. Over the long run, strong earnings do support higher stock prices. But in the short term, prices are driven by expectations, valuation, positioning, liquidity, and sentiment. When these forces outweigh the earnings result, stocks can fall even when the numbers look good. Understanding this helps investors avoid emotional reactions and focus on the bigger picture. In summary, stocks fall after good earnings because markets trade on expectations, not outcomes. They care about surprises, future guidance, valuation, and broader conditions more than past performance. Once you understand this, earnings reactions stop feeling random. They become signals about what the market was already expecting and what it believes comes next.